Sure, I'm going to talk about a paper that's called The Cyclicality of Risk and Risk Premia, and sharing work with Eben Lazarus, who's at UC Berkeley. So the motivation for the paper comes from two well-documented stylized facts about financial markets. The first one is that in bad times, so think of recessions or macroeconomic downturns, financial market risk tends to go up. Kind of visualize that. Here in the figure, I've plotted the volatility index, VIX, of the S&P 500 in blue, and in shaded gray are NBR recession periods. So clearly, the tendency is that in recession periods, financial market risk is higher than in non-recession periods. The second stylized fact is that as risk goes up in bad times, so does the risk premium that investors require for holding on to the stock market. So the aggregate risk premium also tends to go up in bad times. So looking at these two quantities, these two measures in isolation, they both feature such a counter-cyclical pattern. What's less clear, though, is how the risk-return trade-off varies with the state of the economy. So here I want you to think about the ratio of the risk premium of the market over risk. So intuitively, if we think that moving into bad times, investors become more risk averse, then as risk goes up, the risk premium should increase by more than 1-to-1 with the risk, making the ratio of risk premium to risk in itself a counter-cyclical quantity. There is some evidence of such counter-cyclicality for the Sharpe ratio of market returns. So as we all know, the Sharpe ratio is this ratio of risk premium to risk, where risk is equated with market volatility. But the Sharpe ratio is not the only interesting risk-return trade-off that we could look at. So what we're going to do in this paper is we're going to motivate and investigate a small modification of the Sharpe ratio that we call the price per unit of variance risk. So essentially what we're going to do is we're going to look at the cyclical patterns in the risk-return trade-off, that is the risk premium over risk, where risk is equated with market variance. Another way of putting it is the market Sharpe ratio divided by the conditional market volatility once more. So one might argue that, well, volatility and variance are very connected. They map 1-to-1, and volatility is just the square root of the variance. And if you take a time series regression of volatility and variance, you get a very high R squared, and the slope coefficient is going to be positive and extremely statistically significant. Therefore, it's natural to conjecture that cyclical patterns in Sharpe ratio and gamma, that we call the price per unit variance risk, are somewhat similar. So taking risk premiums and dividing it by volatility or by variance shouldn't really matter so much for the cyclical behavior. This conjecture, however, turns out to be incorrect. And that is one of the main findings here in the paper. So we know quite a lot about the cyclical patterns of the Sharpe ratio. So there's some empirical evidence showing that it moves counter-cyclically with the state of the economy. And from a theoretical point of view, just think of the habit formation model of Campbell and Cochran, where counter-cyclical Sharpe ratio is a natural outcome of that. So often what we do is we project our knowledge from the Sharpe ratio risk-return premium onto other measures of the risk-return ratio. So that seems sensible if the above conjecture was right. But now that we're going to show that the cyclical patterns in gamma is going to be opposite to that of the Sharpe ratio, it's of course important to understand when we use the Sharpe ratio, when we use the gamma, we should use different cyclical patterns in our computations. So as a note to that, I think it's important to think about how we use these quantities. So the Sharpe ratio, we all know, is extremely important for portfolio formation. Think about the standard capital asset pricing model. The Sharpe ratio pins down the slope of the capital market line and tells us something about optimal portfolio choice. It's also important, or a reasonable important measure for evaluating different trading strategy and investment performance. Gamma, on the other hand, is used in other parts of financial economics. They're related, but it kind of fits in a different way. So since this is a derivative session, let me focus on the option pricing. So one can show us, I'm going to talk about later, is that this gamma one can think about as a parameter that drives the wedge between the risk-neutral distribution of market returns and its physical distribution. So it's a parameter that helps us govern how different these two distributions are. So its cyclical pattern tells us something about, well, the differences, and therefore also risk premia, or just how the moments vary with the state of the economy. So it tells us a lot of implications for how we think about option pricing and the risk premia that are embedded in option prices. There are several other interesting implications of pro-cyclical price per unit of variance risk. One is that it can help us rationalize why there's a seemingly very low predictive relationship between the expected excess return on the market and market variance. So if you just think about a standard Merton type model where we have expected excess return on the left-hand side is equal to the variance of the market and then the price of that variance. So if the price of the variance was constant, expected excess returns and variance move 1-to-1. If we take it to the data, that's not at all what we see. We see that there's a very, very weak relationship between expected returns and variances. So a pro-cyclical price of risk can help us try to understand why this is a seemingly disconnect between expected returns and variances. Simply because as variance goes up, the price of that variance price per unit of that variance goes down. The overall aggregate risk premium still goes up, but just less than 1-to-1 with the variance. I'm also going to talk about some implications and how we reconcile this with the equity term structure. So we show that there's a clear connection between the pro-cyclicality in the price per unit of variance risk and several aspects of how risk is priced at various horizons. I'll get more into details with that later. So in the paper, we have three main results. The first one is that we provide a clear, we think at least, economic interpretation of this price per unit of variance risk. In that it is, you can think of it as the conditional beta in a regression of the SDF onto the market. So the price per unit variance risk tells us something about how much an investor who's holding the market is exposed to SDF risk. So when the price per unit variance risk is high, it means that the relationship is stronger, such that movements in the market leads to greater variation in the SDF. So since we find that the price per unit variance risk is high in good times, it means that plus minus 1% movements in the market in good times leads to larger SDF variation than in bad times. So with this hopefully rather clear interpretation of how we could think about this price per unit of variance risk, we go to the data because, well, we can motivate all we want, but we also want to see in the data how this actually plays out. And here we provide several interesting empirical facts about the price per unit variance risk. So I'm going to focus mostly on the first bullet here, which is our first main empirical finding, in which we show that this price per unit of variance risk tends to be higher in normal non-recession periods than in recession periods. And here we have to be a little bit careful because recessions are determined ex post, and there's typically a lot of financial turmoil in the beginning of recessions, but we have some strategy to take care of that, we think. Nevertheless, our results show rather robustly that the price per unit variance risk is, well, I would say, at best as cyclical, and in most specification actually moves pro-cyclical with the state of the economy, at least through recessions. We corroborate this evidence using a variety of different macroeconomic variables that are typically tied to the state of the economy. For instance, consumption growth, valuation ratios, industrial production, different financial condition indicators. And in all our specifications, what comes out is that the price per unit variance risk indeed moves pro-cyclically with the state of the economy, as opposed to the Sharpe ratio that in some of the specifications moves significantly counter-cyclically with the state of the economy. So we document these facts in a broad global sample covering 20 stock market indexes around the world. And we do so using 3 different measures of this price per unit of variance risk. So as I'll get into more details a little bit later, unfortunately, this quantity is not directly observable to us as econometricians. So we have to infer it in one way or another. And no matter how we're going to do it, there's going to be some pitfalls with every method. So we choose to use 3, I would say, fundamentally different ways of looking at the same quantity. So we have a realized measure that's based on realized returns, expected measure that's based on model predictions, and an option implied measure that is based on options written on the US stock market. Now, once we've hopefully rather convincingly showed that the price per unit variance risk has this an opposite cyclicality as we would initially probably have thought, we're going to reconcile our finding with the literature on the equity term structure. So we find it important to try to connect 2 risk prices that previously have been looked at largely in isolation. And we do so through a stylized model in the spirit of Litau and Wachter, where the main ingredient that we add to this model framework is that we allow return volatility, so returns on dividend strips, to have 3 components. There's a component that's related to fundamental dividend risk. So that's a constant volatility related to fundamental risk. There's a volatility that's related to the price of risk, or the discount rate. And then there's the added ingredient that we add is non-fundamental volatility in the dividend process. And importantly, we allow this non-fundamental volatility to increase in bad times. So when the price of risk is high. So price of risk in this world, you should think of as risk aversion is high, which is typically bad states of the world. So with this non-fundamental volatility that increases in bad times, it allows us to disconnect expected excess returns to risk. So in bad times, overall market risk goes up, but it doesn't go up one-to-one with expected return because some of this market risk is not priced. So only some of it feeds into the expected return, which allows us to get a pro-cyclical pattern in the risk-return trade-off. Importantly, as we'll show, we still get counter-cyclical Sharpe ratios, downward sloping term structure of Sharpe ratios, and our pro-cyclical price of variance risk. So we're able to reconcile this finding with the whole equity term structure literature using a single extra ingredient, which is this non-fundamental volatility in the dividend process. So we think that's quite cool. We have further results that I won't talk about today, but we have some CAPM holding period return model, and we have some results on constant risk option portfolios at different horizons. And in all of these extra applications, we generally find that a pro-cyclical price per unit variance risk is consistent with the term structures we observe in the data. Good. So the rest of the talk is going to be as follows. I'll present this motivating theory. It's going to be very light theory, but it's just kind of, we want to put a mental picture in your head of how we want to think about this price per unit variance risk and how we want to frame kind of the metric as a whole. Then I'll talk about how we compute these measures, take it to the data, and show you the term structure model at the end. So let me just jump right into it. So we're interested in the ratio that we call gamma t. It's a ratio of the expected excess return on the market over the market variance, so the price per unit of variance risk. It's important to note that we are not the first ones to look at this quantity. There are several interesting papers. 2 in particular come to mind. One is Moore and Morea's JF paper on volatility managed portfolio. Essentially what they do there is they create a strategy where they have a portfolio where when volatility decreases, they move into the market. the volatility increases, they move out of the market. So I have a constant risk portfolio. They show that that portfolio generates high risk return trade-offs. And in terms of our finding, that mimics the fact that they are heavily loaded in the market in good times. And in good times are the points in time when volatility is low, are typically periods where the price of risk is very high. There's also a nice paper by David Schreindorf and Tobias Sickert. Is in the JFE. I think it's 2025 now. I apologize that it's 2023, where David and Tobias show that the projection of the pricing kernel is steeper at times when market variance or market volatility is low. So as a function of market volatility, they show that there's a steeper pricing kernel in good times measured as market variance, market volatility, and it's less steep in bad times, which also speaks to our results is that if we think about variance as the cyclical variable of interest, then they also find this kind of pro-cyclical pattern in the slope of the pricing kernel, which one can think of as a measure of the price per unit of variance risk in particular models. I'll go into more details shortly. So we're going to extend the previous literature in several and I think in very important ways. So first of all, we're going to disconnect the price per unit of variance risk to variance as the measure of cyclicality. So we think about cyclicality, I think, in much broader terms in terms of, for instance, recessions or macroeconomic variables that are typically tied to the state of the macroeconomy but are not necessarily one-to-one with the variance of financial markets. We show that these results hold in a broad global sample and provide theoretical justification or intuition for it. And lastly, we think we're the first ones to look at how this price of variance risk relates to how risk is priced at different horizons. So before we go into the data, I think it's important to note that gamma T is not the common way to think about the price of risk. So if we just take us back to standard asset pricing books, if we assume that there's no arbitrage, there exists an SDF such that the standard asset pricing formula holds. So there's some SDF that prices all assets, even the market. Typically, what we do is that we rewrite this equation, this standard asset pricing formula, such that we have an expected excess return is equal to the negative of the covariance of the SDF with the return. Right? This is a very common representation, and we arrive at a single beta representation by multiplying and dividing that equation by the variance of the SDF. With that, we end up with a representation of the excess return on the market. That's beta. Here, it's denoted R onto the market. So you can think of it as this is the beta similar to a regression of the returns on the market regressed onto realizations of the SDF. So in typical terms, we call that the quantity of risk. And then the rest, here it's largely just the variance of the SDF, is then the price of risk. So what we're going to do is going to relabel these quantities a little bit. So we're going to start from this standard formulation that we have the expected excess return is equal to the negative of the covariance of the SDF with the market. But instead of multiplying and dividing by the variance of the SDF, we multiply and divide by the variance of the market. That's going to lead us to a very similar type representation, but one that has an alternative interpretation. So we get to an expected excess return that's equal to the beta now it's of the SDF onto the market. So the beta here you think of as the slope of a regression of the SDF onto the returns on the market. So we call that the price of market risk, price per unit of market risk, where the risk is then just the variance of the market. So this is the beta that relates the SDF to the market returns. So to kind of depict that, I've plotted here just simulation of an SDF realizations here on the vertical axis, and on the horizontal axis I have realizations of market returns. The slope of this line is the beta which is similar to the price per unit of variance risk. Now, what happens is that cyclical patterns in the price per unit of variance risk means that the steepness of this slope changes over time. So intuitively, if the price of risk increases, then somebody who's holding the market is exposed to greater variation in SDF realizations. So here is depicted in the orange dots that this is a period where the price of variance risk is very high. It means that small movements in the market can lead to rather large movements in the SDF. Or said differently, a plus minus 1% market return exposes the investor to greater SDF variation when the slope is steeper, when the price per unit of variance risk is high. So if we think about kind of like like cyclicality being fully driven by the variance of the market itself, this very closely mimics some of the results and intuition of Tobias and David's paper, that the steepness of the projected SDF is higher in low volatility times. Now, what we're going to look at is, of course, a broader set of macroeconomic conditions for what constitutes good and bad states of the world. And our finding that the covariance of the SDF with the price of variance risk, that is negative, so it's pro-cyclical. So in good times, the price of variance risk is high, and this is typically periods where SDF realizations are low. So the pro-cyclicality of the price per unit of variance risk means that, to some extent, going into bad times, the stock market is doing its own thing. There's some risk that goes into the stock market for which the risk premium does not accompany it. So the risk premium does not go up one-to-one with the risk when we go into bad times. So this is kind of the intuition that led us to put this non-fundamental risk into the dividend process in the term structure model, as I'll get to later on. It seems like there is a disconnect once we move into bad states of the world. Disconnect between the risk premium and the variance. Now, with this intuition, the next thing we want to do is we want to look at the data. And the first challenge we face is that we don't know exactly how to compute the price per unit of variance risk. So there are several ways in which it can be done, and any one way is good in some aspects or bad in others. So we're going to do it in many ways. So I think hopefully that speaks to the robustness of our results. So we consider first a realized measure. So this is what we call the most naive measure. For the realized measure, we're interested in monthly horizon price per unit of variance risk. For the realized measure, what we do is just use daily returns to compute expected excess returns within the month, realized excess returns within the month, and divide it by the realized variance within that month using daily returns. Of course, one can think of that as a little bit naive. It's also extremely noisy because, well, returns are noisy, and even computing variances with such short window is also a rather noisy process. So we want to do something that's a little bit more involved. So our second measure does that by computing expected measure for both the expected return and the variance. So instead of using realized measures for expected return and variance, we use models to predict them. So for expected excess returns, we use the Kelly and Pruitt 2013 JF paper that relies on the cross-section of valuation ratios to get out a prediction of the expected excess return on the market. So we choose to use their measure because, well, we have data to compute it in a broad global sample, and it's been shown to be a good predictor of monthly horizon excess returns both in and out of sample. So we want something that actually predicts excess returns, which is of course very difficult, particularly at the shorter horizon. But this measure seems to be doing quite well. In terms of variance, we say variance, instead of using realized variance, we use an expected variance where variance follows an AR1 process. We've also played around with other measures, other models for the variance, like allowing for long memory, long horizon predictors, like a Corsi type model, but it doesn't change the results at all. So for now, we're not just sticking with the simple AR1 model. Now, the last measure is the option implied one. So since we're a derivatives crowd, let's take a closer look at that. So the option implied measure is a little bit more involved than the other ones, because here we're not predicting or computing expected returns and variance in isolation. We're kind of computing the price of variance risk in one go. So the general idea we're behind what we're doing here is that we're tweaking the method that Bliss and Pangasulo suggested in the 2004 JF paper called Option Implied Risk Aversion, as they're called, by allowing for time-varying risk aversion. So this risk aversion coefficient can, in some models, be shown to be equivalent to the price per unit of variance risk. So we apply a few identifying equations that allow us to get out a time-varying risk aversion that best reconciles the observable option prices to the time series of realized market returns. And the overall assumption behind what Bliss and Pangasulo does and what we do is that there is an SDF projection that has the following representation, that the SDF projected onto the market has this power utility-like feature. So there's return on the market raised to the power of minus some gamma tilde here, where gamma tilde is in some applications exactly the same as the price per unit of variance risk. One can think of it easily as if you take logs on both sides of this equation, this is not an exact equation here, it is a scaling parameter, you would get that gamma t there, gamma tilde t is the parameter that governs the regression of log SDF realizations onto the log market returns. So they are, at least in that sense, very, very, very similar. And in some models, they're actually identical. Now, this is just, so far, this is just taken out of the Bliss and Pangasulo paper. So what we do in this methodology to kind of allow for risk aversion to be time varying, because in their paper, the 2004 JF paper, risk aversion is constant. So what we do is we say, well, there are two parameters in this model. One is the risk aversion, and the other one is the time preference parameter. So what Bliss and Pangasulo do is that they find a risk aversion parameter, and then they let the time preference parameter kind of do the rest, making sure that the distribution integrates to one. So it's a probability distribution. So we're going to do it kind of the other way around. We're going to say, well, we think the time preference parameter is the least interesting parameter in this model. So we're going to parameter it. We're going to just say how it looks. So what we do is that we say the time preference parameter, which we here denote delta. So in the bottom right, you can see that there's an expression for delta that's 1 over the risk-free rate plus a constant c. So this constant is time invariant. And that's the number that we're going to maximize over. So we're going to say, well, find a c, and then use a time series of risk-neutral distributions and subsequent realized returns to evaluate whether that c is the right c under the constraint that at every point in time, for every c, we can solve the constraint that gamma t makes sure that the resulting distribution is a probability distribution. So essentially, if you look a lot into the recovery literature, this is similar to what we have as an equation in my old JFE paper with David and Lazarus. Essentially, just making sure that we can optimize, we can figure out what the parameter is, because the distribution has to integrate to one. So with this little tweak, putting structure on the time preference parameter rather than the risk aversion, we can allow for risk aversion to be time varying. Good. So we compute these three measures And here's a picture of how it looks. So in the dashed green line here is the realized measure. It's a 12 months moving average because the realized measure is clearly a lot more noisy than it looks here. So we take moving averages. In the blue is the expected measure, goes back to 64. And in the black is the option implied measure. So at first glance, I think it's pretty clear to see that they seem to have the same kind of cyclical pattern. So there's at least many similarities in how they vary over time. If you just take raw correlations are around 25 to 50%. So they're positively correlated. They do not necessarily capture exactly the same variation, but they're positively correlated and seem to have the same cyclical patterns at least. Now, with these different three time series, or say this is for the US market, we also have it for the 19 other markets. With these time series, we're going to investigate how they vary with the state of the economy.
Can I jump in with like a couple of questions about more the theory? The first one you probably expect because it comes from a theorist in the chat. Like, how about all of the Martin bounds? So if you use them to measure equity premium, would the empirical result change?
So you're saying, sorry, the margin bound in terms of
for equity premium bounds, as in what do we find if we use option-based equity premium bounds, as in Martin 2015 work? And Mohammed, feel free to unmute yourself to follow up because I'm not a theorist.
So yeah, it's going to be violated sometimes. There is a paper that's shown that these bounds are violated in the data. But I mean, for our sake, we're not so concerned with that, because what we want to do is largely just to say, well, we have option prices. Option prices convey some information about this quantity that we're interested in. We need to put some structure on the model to generate this quantity. This Bliss and Pangasius way of doing it allows us to get a quantity out. Of course, I mean, the power utility assumption, or Ian Martin's like log utility type assumption, is violated in at least as a lower bound in some applications, and that's just how it is. So for us, that's not the main point of why we're doing it. We're not particularly looking at the expected excess returns. So I think from that point, I think what an interesting thing to do, which is something I actually have done, is to compute the expected returns more directly. Because what we're interested in our option application is kind of the risk aversion coefficient. If we in our expected measure instead used Ian Martin's or Chabillot-Wilcoff method, or some of these other measures, we could directly plug those into the expected returns, so in our expected measure. And I actually did that at some point, and it turns out to be very similar in results to what we get with the Kelly-Pruitt result, Kelly-Pruitt measure. So in terms of what we're doing and what we're going for, I think the fact that this methodology might, in some cases, be non-consistent with the NCC and the lower bound of the margin world is something that we're not particularly concerned with. But it's a valid point, and it's something that also led us to use another measure as the expected excess return than option implied measure.
And then a quick question from me as a non-theorist, like, of course, like the main challenge is measuring a market risk premium, right? So we measure it with a lot of noise. If you can run like some kind of like a simulation, like the concern would be that the noise and estimate somehow like correlates with the outcome and propagates and creates some spurious results where, I don't know, like the equity premium, our estimates of equity premium really don't change much from period to period or change too much. Like, have you run some simulations to show how this noise would affect or wouldn't affect?
No, we have not done that. I think that's a good suggestion. That's something that I could do. But to kind of speak to that, that's also one of the reasons why we wanted to do this option implied stuff, because there we're not directly computing these quantities, right? So that's a measure that kind of is distinct from at least that concern. So it gives us at least confidence in that direction that our results would well, our results hold. Right? But the
and
simulation
finally,
study is a good idea. It's something we could do.
Finally, David Schendorfer has a comment in the chat. I don't think it's a question. He says, that's interesting. Martin bound is approximately EP equals variance of returns under Q. So the price of variance ratio would be Q variance over P variance, an unconventional measure of the variance premium. I don't think it's a question, but it looks like a comment. So.
Yeah, that's in the margin world. That's very true. Yeah, that's very true. Now, so let me move on, because time flies, particularly when you're the speaker. So in terms of our empirical analysis, the one thing that I want to focus on is what we do with our recession analysis. So we want to investigate how these quantities varies with the state of the economy. So I'll start to show you some results on recessions, and then you just have to believe me that all the results we can kind of corroborate with alternative measures of what constitutes the state of the economy. Now, the first question we want to answer is the price premium variance risk higher in recessions than in normal times? So it's using recessions as the cyclical variable. But there's an important thing to notice here is that recessions are typically determined ex post. So ex ante, investors might not know that they're in a recession. And also, in the beginning of recessions that are determined ex post, we typically see financial market turmoil. So we see low returns and very high variance. So these outcomes might affect our results if we do not take that into consideration. So what we're going to do is we're going to ask, suppose you as an investor had perfect foresight in investors and could enter the market at any time. When would you choose to do that? So a natural answer to that question would be, well, I would want to enter the market when the market has reached its low. So if we're in a recession, I had perfect foresight. I saw, well, today the market has reached its low during the recession. I can buy the market, and I know for the rest of the recession it's just going to go up. Now, of course, it fluctuates, but it's never going to be lower than where we are right now. So this investor is the starting point of our analysis. So we're going to think about an investor who invests in recessions, in all recessions, but always enters the market when the market has reached its low during the recession. So taking out all the initial turmoil of the financial market that's in the recession. So we call this kind of a perfect foresight investor. And our idea here is to say, well, we're going to compare this investor that we give, let's say, extra power in recessions to an investor who just invests in normal times. So we're kind of giving the recession investor a bit of a helping hand, with the idea that, well, if we give the recession investor a helping hand, and that investor cannot outperform the normal times investor, it's at least an indication that without a helping hand, they couldn't outperform them, right? So let's start by looking at some results about the Sharpe ratio. So there's evidence in previous literature. Lucy Bettelheim has a very nice paper in the JME showing that the Sharpe ratio has a counter-cyclical feature. And there's some, of course, some theory that kind of tells us that as well. So what we do now here in the first analysis, looking at the Sharpe ratio, so look at the first part of the table, it says unconditional Sharpe ratio. What we do is we say, well, we take all the months that were non-recessions and put the returns on the market into one bucket. Then we take the 12 months after each market low in a recession. So in each recession, we find the market low and take the subsequent 12 months returns. We take all those and put them into another bucket. So we have a bucket of returns that are from the market low and in normal times. And then we compute the Sharpe ratio in each of these buckets. So what the first part of the table shows you is that in recessions, this perfect foresight investors earn Sharpe ratios of roughly 0.5. In normal times, this investor earns unconditional Sharpe ratios of about 0.2. The difference is statistically significant, showing that, well, for the Sharpe ratio point of view, there seems to be a higher risk-return trade-off in bad states of the world. And the results are roughly similar if we take average of the conditional Sharpe ratios that we can compute from our realized, expected, and option implied measures. So the Sharpe ratio seems to feature this counter-cyclical pattern for our investors. Now the picture is a little bit different once we look at the price per unit variance risk. So here the first part of the table with the unconditional price of variance risk. Again, that's the two buckets of monthly returns of the normal times investor and the monthly returns after the market low for the recession investor. So what we see here is that in recession, we get a point estimate that's a little bit higher than in normal times, but it's never statistically significant for the unconditional price per unit variance risk. If we look at the average conditional prices of units of variance risks, the picture changes a little bit because here we even get negative point estimates. So the difference in the lower part, here we find that difference in the post 64 and 96 samples, point estimate is negative. It's not statistically significant. But this to us says that, well, if the perfect foresight investor cannot earn a higher price per unit variance risk than someone who just holds the market in good times, it's very difficult to think of the price per unit variance risk as ever being higher in recessions. If anything, it's probably lower because real investors do not have perfect foresight. So if we look at our other more, say, complex advanced measures, the expected measure and the option implied measure, we even get negative coefficients, negative differences, meaning that the price of per unit variance risk is higher in good times than in recessions for this perfect foresight investor. And the difference is statistically significant. So this to us speaks to the pro-cyclicality in the price per unit of variance risk. So I would say as an upper bar, this result shows that the price per unit variance risk is at best acyclical, but probably pro-cyclical. Whereas the Sharpe ratio is clearly counter-cyclical, speaking to the differences in the cyclicalities of these two quantities. So these are the US results. We also have some results on a more broader global sample that kind of points in the same direction. So if you just focus on the first two lines in this table, that's the same kind of analysis, just with a pooled panel regression of the 20 stock market indexes. Sharpe ratio is statistically higher for the positive coefficient 0.17, that's statistically significant, means that the Sharpe ratio is statistically higher for the perfect foresight investor. But for the price per unit variance risk, that's in the last two columns, the point estimates are indistinguishable from zero and even have negative point estimates for the expected, which again speaks to the fact that, well, if we give these investors in recessions think of the best possible help we could give them, they still can't outperform somebody who's just holding the market in normal times. We think that's pretty clear evidence of the fact that the price per unit variance risk is very far from being a counter-cyclical quantity. It's probably acyclical if you want to take it to the limit, and the more reasonable assumption is that it's a pro-cyclical quantity. Yeah, so I don't have that much time. This is not that important for now. So we show these results using a variety of other measures as well. So we have some Chicago Fed index and indicators capturing different aspects of and conditions in financial markets and in general economy. We have various real activity variables like industrial production growth. We use valuation ratios, consumption growth. In all of our specifications here, we tend to find the same thing, that the price per unit variance risk indeed moves pro-cyclically with these variables. And that's true in a broad global sample and for all the three measures that we're looking at, suggesting that this is indeed a broad phenomenon, and it's a very robust result. Now, for the last minutes, so as I see here, my time is flying. I want to talk about this model that we have in mind, because now, hopefully, I've convinced you that this price premium variance risk should not be thought of as a counter-cyclical risk-return trade-off. If anything, it should be thought of as a pro-cyclical risk-return trade-off. So what we want to do now is we want to reconcile that pro-cyclicality with the equity term structure of how risk is priced at multiple horizons, different horizons. So let me just jump right into the model that we have in mind. So we reconcile our finding in a stylized model that's similar to later on back to 2007. But with the one important difference is that in the dividend process, in the dividend growth process, we allow for this last term. So you see here, there's the dividend growth process, growth, there's the just inequality, and there's two shocks to the dividend process. There's a shock epsilon D that is fundamental, something that is priced. And there's a shock epsilon Z that is non-fundamental. The volatility of this non-fundamental shock increases in xt, which is the price of risk. So the state variable in the model, the risk aversion in the model. So a high xt means that we're in a bad state of the world. So we allow for this extra component in the dividend process, and that's going to feature into the expected return on dividend claims, such that when we go into bad times, variance goes up because this non-fundamental risk increases, but the expected return does not go up as much as the variance does. So that's a general idea. We do similar, like standard things, specify the log-stochastic discount factor. You know, if you have this SDF M, you notice that the only shock that goes into M is epsilon D, so the priced shock. So the epsilon Z is of course not there, and then the price of risk is driven by this single state variable. Now, what we can do in this model is we can derive the Sharpe ratio and the price per unit of variance risk, and that's the next thing we do. So taking this model, solving it, and we can derive expected excess returns and variances and volatilities in these dividend claims. So we can first start with the Sharpe ratio. So the Sharpe ratio is the expected excess return over the volatility of these claims. Turns out to have this expression that's here in the right. So we see that this has a downward sloping term structure because longer maturity claims are exposed to greater discount rate risk. So that comes through the B squared there at the end of the volatility. Importantly for us is that if we take a first derivative of the Sharpe ratio with respect to the state of the economy, xt, we find that the first derivative is positive. So the Sharpe ratio, it increases when risk aversion increases. So it increases in bad times. So we get this counter-cyclical Sharpe ratio. This is kind of consistent with Campbell-Cochran and what others have shown in previous literature. Now in the model, if we do a similar thing for the price per unit of variance risk, we get the following result. So if it looks very similar to the Sharpe ratio, just we don't have the square root over the variance. So we get the price per unit of variance risk, take a first derivative with respect to the price of risk, and we get this expression that's here in the middle. This expression can be both positive and negative. It's negative, meaning that there's a pro-cyclical price per unit of variance risk if the following condition holds. So the condition down here, it looks a bit ugly at first, but it's rather intuitive. So what we have on the left-hand side is the volatility of the unpriced shock. What's on the right-hand side is the volatility of the price shock and then some scalar to it. So essentially it means that the unpriced shock has to be, quote unquote, important enough, has to be large enough to for the price per unit of variance risk to be pro-cyclical. So what we achieve with this model is a way to get our stylized fact about how the price premium variance risk is pro-cyclical, that the regression of the SDF onto the market is lower in bad times and higher in good times. Take that, reconcile it with a downward sloping Sharpe ratio term structure and a counter-cyclical Sharpe ratio using only one channel, that is this non-fundamental return risk that we feed to the model through non-fundamental risk in the dividend process that increases with the price of risk. So the last thing I want to show you now is a simulation of the model, illustrative quantification of the model, that is. So we take the model to the data just to make sure that it actually fits data with reasonable parameters. So we choose parameters similar to what Niels Gormsen does in his JF paper, and we match the steady state price of risk such that we get an excess return of 7% at every maturity. So excess returns are constant. Unconditionally, the volatility decreases in horizon. So that's increases in horizon. That's what we saw with since longer maturity claims are more exposed to dividend volatility, meaning that the Sharpe ratio is downward sloping, right? So if the expected excess returns are constant, volatilities increase horizon, Sharpe ratio is going to be downward sloping. So that's the first feature we want to capture. The second feature we want to capture is the cyclicality of the Sharpe ratio, because we know that that's counter-cyclical. In this model, we look at the price, this quantity, the Sharpe ratio in different states. So here to the right, we have the very bad times when the price of variance risk is very high. The price of risk, XT, is very high. And to the right, we have good times where it's less than that it's steady state. So what we see is that in very bad times, the Sharpe ratio tends to be higher than in good times. So we kind of capture this fact that going into bad times, Sharpe ratios are high. In good times, Sharpe ratios are low. If we look at the price premium variance risk, it's reversed. So with these parameters that are typically used in the literature, we find that the price premium variance risk is actually lower in very bad times than they are in good times. So of course, this is the top decile. Defining what is very bad times in such a model is of course a little bit ad hoc, but these are the general tendencies that we found. Good. So I didn't make the 50-minute mark, but it's close to it. At a high level, what I've shown you is that when total variance of the market goes up, much of this variance seems to be stock specific. It's like when variance goes up, the expected excess return do not follow up one-to-one. So stock market is in some sense doing its own thing. It does something that investors do not require compensation for. So we provide this clear economic intuition for how we should think about this price premium variance risk as the conditional slope in a regression of the SDF onto the market, using three fundamentally different measures of how to compute this quantity in the data. We show that it is indeed pro-cyclical. As an upper bar, it's an acyclical quantity. And this is true in a broad global, in this broad global SAM, we're covering 20 stock market indexes. And lastly, we show that we can reconcile the pro-cyclicality in this price premium variance risk with key facts about the equity term structure. So we can reconcile our finding with what we kind of know from previous literature. Good. So yes, that's what I wanted to say. So if you have any questions, I'm more than happy to talk.
I think we have at least one. So yeah.
At least one.
Yeah. Hi, how you going? I'm calling from a. Can you hear me first?
Yep.
I'll try. So.
Yeah, so I'm calling from Australia. Firstly, great paper. I think it's an excellent study. In practical terms, does that mean leverage should be increased in good, I mean in inverted commas, good times? So leverage should be increased in good times and rebalanced in bad times? Is that sort of the main, or am I missing sort of? Because from what I understand
Sorry,
that
I
variance.
can't hear you clearly. Dimitri, can you hear?
Hang
Let,
on.
let me try to translate. I think like the question is just like, well, in practical terms, so if we want to use this to make money, right, should we increase the leverage in good times or should we increase the leverage in bad times, right?
Can you hear me now? Is that better?
Yeah, that's better.
Yeah, I'm taking off my headphones. Sorry. Yeah, the way I understand it is that variance is not infinite, but not bounded. The way I understand is that variance isn't bounded, and therefore your variance is unstable in bad times and much more stable in better times. So hence you have a much more robust effect in good times than you do in bad times in terms of a return sequence.
So you're saying that our computation of the variance is going to be more noisy in bad times.
Yeah, that's what I imply from this results. That's what I imply from these results.
Yeah. So what we did to kind of speak to that was we said, well, suppose variance is simply too noisy. It fluctuates too much relative to what investors are actually pricing. And so what we did is we looked at longer horizon variances because these seem to be a little bit less affected by the variation that happens over time, right? They're more stable over time. And using longer horizon variances, that we have more data to compute, right? We can get better estimates of what these actually are. We get similar results. So that kind of speaks to results are slightly weaker, but the overall tendency is the same. So that I think speaks to the fact that I don't think it's the fact that we miscalculate variance more in bad times. But I think going back to a point I made earlier is I think that's why it's important that we also have this option implied stuff. Because the option implied stuff has nothing to do with how we compute the variance, right? So that's just
That's
distributions from the data.
Yeah.
But it's true. I mean, that's why we're doing this in different ways. Because I mean, particularly when we compute the realized variance over the month using daily returns, that's it is something that's computed with a lot of noise. So that's why we feel it's important to do this in several and very different ways.
Yeah, that's really interesting. Can you explain the optionality a bit more? So does that mean like the sort of the optionality across the market changes against the variance? Is that what you mean? I'm just sort of trying to pick up on that because I was just reading that last night. So
say again the optionality. I didn't catch the next thing.
Yeah. Let me just try. So there's some optionality in the variance structure that you've put forward, which is really interesting. So that the gamma effect obviously changes under whether it's good or bad times. So just because there's been a lot of option papers recently that have sort of mentioned about like theta decay and a few other things. So does that mean more optionality should be used in bad times or good? I just didn't understand that sort of like inference.
That I have not thought about. That's not.
That's okay.
From the top of my head, I don't have a good answer to that. I think I need to think of
That's all right.
about
I
it
was just trying to pick it out
because
last
that's not the direction we're pushing it. But I think it's very interesting that you think of these directions because there is a lot of implications for particular option literature on this, such as like change in cyclical pattern. But as of now, we haven't really devoted ourselves to that direction. So I have to owe you an answer.
I was trying to work out some math last night on the optionality of it. But yeah, it's a fascinating paper. Honestly, you've done amazing work with it. I think it's really, really interesting.
So just to summarize, so yeah, it's the variance in bad times becomes mispriced or like not compensated for essentially.
Yeah, that's an interpretation, right? That there's something happening with the stock market that kind of disconnects compensation for risk with aggregate market risk. So there's some risk there that seems to be not priced.
Yeah. Oh, very good. Very good. Thank you very much, guys. Enjoy.
Thank you.
All right. Any other questions? Christian? Quite impressive.
Can I?
Go ahead.
So one thing that I mean, the work of In-Hao Cheng and some other papers have shown, also we have a paper on that, is that this variance risk premium that switches sign, essentially p-variance, physical variance, exceeding the risk neutral variance in bad times. And as David mentioned, a lot of these equity premium bonds, option-based equity premium bonds, are essentially saying that equity premium is related to the risk neutral variance one way or another. Mm-hmm. So essentially this means that you are dividing the risk neutral by physical variance or up to a constant multiplied by it. And then that means that if during bad times your variance risk premium switches sign, that means risk neutral variance is smaller than physical variance, that essentially confirms the results. Maybe that can be something that helps essentially the empirical results, like the work of In-Hao Cheng.
So I think that result you can find in several ways, right? Depending on how you think about preferences and the pricing kernel of the market. The way I always thought about exactly that, there is more speaking to kind of the shape of the distribution in bad times rather than necessarily the risk aversion that's used, or the price of that risk in bad times. But I agree. That kind of variation speaks to the fact that there seems to be a lower projection in these bad times. That's true.
Anyone else?
Hope that answered your question in a satisfactory way.
Well, this was lovely. Christian, thank you again for taking the evening to do this. And thank you everyone for joining us from all over the world.